Hello, chart watchers, and welcome to this Wednesday, July 11th Market Watchers Live show with your hosts, Tom Bowley and Erin Swinlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, we woke up to some additional tariffs this morning. We'll talk about that in a bit, but the Dow Jones Industrial Average currently down 200 points, its lowest level of the day. The S&P 500 down 19. The NASDAQ is currently down 45. And the Russell 2000, after touching an intraday all-time high yesterday, has reversed, and today it's down 9 points. The 10-year Treasury yield is down about 1.5 basis points as it continues to meander below its 20-day moving average. Volatility has picked up, but still remains in this downtrend, currently sitting at 13.82. Utilities leading the market to the upside today. That is a defensive group. We saw defensive stocks leading yesterday, so utilities following through a little bit on its reversal on Tuesday. Materials definitely taking another hit today with the tariff talk. We had gone up. We had basically filled this gap from about 3-4 weeks ago, and we are turning back down off of it. Energy also having a rough day. Caterpillar and Dow DuPont, two of the weakest stocks in the Dow currently. Both of those stocks really hit hard in June on a lot of the tariff talk and the rising dollar, and they are both turning back down beneath their key moving averages. Fastenal came out in that industrial area, though, with exceptional earnings and easily moving higher today and is the top performer in the S&P 500. Okay, well, it's hump day, Erin, and we got the market now. Yesterday, like I mentioned, the Russell 2000 tried to break and actually did on an intraday basis, hit an all-time high, but we see the market reversing and moving lower. Looks like maybe a little weakness ahead.
Indeed. And wow, that was the name of my Decision Point article last night.
What was that?
Well, we got all these red arrows, or I'm sorry, green arrows on the DP scoreboards, but my caveat was to watch for short-term weakness. Mm-hmm. And sure enough, my indicators so far are on, but you know, it is a day. It's hard to take credit when there's just a down day after you write. So,
yeah, I know, with the S&P 500, for instance, we always talk about price is a big thing, whether it's price resistance, price support. And I know the market got off to a good start this week, but the S&P 500 got right up near that 2,800 level where we've had some difficulties getting through. And almost like clockwork, it's down, 2/3 of 1% today, down 19 points currently.
Yeah, exactly. It's the indicators were just getting so overbought. So it's not surprising to see a little weakness. I'm not expecting a huge correction or anything. I don't think you are either. Just a little bit of weakness and a little bit of downside, maybe some consolidation.
Yeah, anytime we hit resistance, I just look for maybe a little bit of selling. Obviously, it would be a big bonus if we could get through. But I'm really excited to have Tushar back with us today because he is going to follow up. Of course, yesterday I did my kind of mid-year review. And I know, Tushar, you're going to provide everybody with some of your thoughts in the second half of 2018. And welcome back to Market Watchers Live.
Well, thank you very much, Tom. And good morning, Erin. Good morning to all of you there. It's great to be back. Yes, we'll talk about a number of things this morning, including my forecast for the year and for the next 6 months. So it should be fun.
All right. Well, I'm not going to ask you to give away any of your thunder just yet, but stick with us and maybe about 10, 15 minutes, we'll come back to you and let you give us your thoughts on the market.
Sure thing.
All right, Erin, take it away.
All right. So what do we have coming up? The rest of the schedule right now, we've got Grayson Rose. He's going to be in tomorrow. I will be doing a sentiment update on Friday. And then on Tuesday, I have a workshop. I'm not quite sure what I'm going to do it on, but I might continue my trading chart patterns and give you more of that since I didn't get through all of them. And Tom McClellan is going to be here next Wednesday. Very excited to talk to Tom. I know he had some very interesting predictions as well. We'll have to see how that worked out. As for today's agenda, we did just introduce Tushar. He's going to be talking about a possible summer rally and what's been going on with that. 10 and 10 to 1, our very first symbol will be 10-cent holdings. And you can go take a look at that chart. Kind of interesting, I thought. And we'll finish off with the scooter report. So lots to cover, and we do have a great guest. So Tom, I'm going to pass it back to you, and let's get it going.
Sounds good. All right, here is a chart of the U.S. 10-year Treasury yield going back really basically to the beginning of the year. You can see that we continue, as I mentioned at the top of the show, continue to struggle to get through that 20-day moving average, which currently is at 2.87, almost 2.88%. We got right up there yesterday, and then today we've dropped back down again with the announcements of the tariffs, the additional tariffs. Couple of economic reports out this morning. We did get June PPI. It rose 0.3%, which was just slightly above the 0.2% that was expected. Core PPI, however, matched estimates with a rise of 0.3%. May wholesale trade came out at 10 o'clock this morning, Eastern Standard, and rose 0.6%. And the market was looking for a rise of 0.5%. So a little bit more of a rise in wholesale trade than expected. But really not a whole lot changes here in the picture technically on the 10-year Treasury yield as we just continue to drift a little bit lower within the recent trading range over the past couple of weeks. We've been in a fairly narrow 5 basis point range, maybe 6 basis point range, and we're sitting almost squarely in the middle of it right now. So it seems like the bond market is waiting for something to happen. I don't know what that something is going to be, maybe with some more economic reports out tomorrow and the kickoff of earnings season. Maybe that'll be a catalyst to get the Treasury yield perhaps to make the breakout above the 20-year Treasury yield. And that's what I'd like to see from a bullish perspective on equities. I'd like to see the 10-year Treasury yield break out because that in turn means that Treasury prices are moving lower, and that money then is available to rotate from the bond market to equities. Okay, well, this morning it was announced, or overnight it was announced that the U.S. Was going to have another round of tariffs, this time a 10% tariff on $200 billion worth of Chinese imports. That is a big number, no matter how you slice it, because we only import about $140 billion worth, maybe $130 billion from China. So if China were to retaliate as much as they could, they still wouldn't be able to escalate this any further. So I think what the market's been saying, and I have a couple of charts here, but I think what the market has been telling us is that we have, I think based on the way the market's been trading, I think that the market is looking to the U.S. to lead based on all of the tariffs taking place. Here is a chart of the S&P 500 versus the Shanghai Composite in China. And take a look, you know, when the tariffs really began to escalate was in late May, early June. And check out what has been going on in the S&P 500 relative to China. Now, it's not like the S&P has been soaring, but if we just pull up the SSEC, which is the Shanghai Composite, see if I can get that to come up. Here we go. Take a look at what's been going on here over the past month. We had pretty good support based on a February low, the second half of April lows, and then again at the end of May, right at about 3,050. On the Shanghai Composite Index. But once that gave way to the downside, it has been a steady move lower, and it fell from 3,050 down below 2,700 just a couple of days ago. That's pretty significant drop in, what's that, 10% or so in 2 to 3 weeks. So clearly the traders are not expecting good things to come out of this for China. And I think that's really what this chart that I had up previously, the S&P versus China, shows us. We could look at it, though, on, looking at versus the other Asian markets, some of the bigger Asian markets. Here's the Hang Seng, and the S&P has clearly been outperforming the Hang Seng over the last 30 days. I did think that it was a little different, though, when you look at the next two. First one is the Tokyo Nikkei, and after the S&P had been downtrending in March and April and into probably the first half of May, it actually has started to outperform the Nikkei again. So the S&P 500, a little bit more of a mixed picture on this one. But the one that maybe you haven't realized is versus Bombay Stock Exchange 30 Sensex Index. Look at what happened. We topped on the S&P relative to India back in the early part of March. But really over the past 3 or 4 months, the S&P has been wildly underperforming the BSE. And if we pull up just an absolute chart on the BSE, you're going to see that we're actually making a breakout here and going back and testing that late January high. So pretty good relative action taking place in India right now. Now, why is the market struggling today? Well, we can point to the headlines. I'm not so sure the headlines really are telling us the whole story. I think the technicals tell us the story. And when you look at the Russell 2000 off of an uptrend, I think we completed the cup yesterday. We did have that break to an all-time high on an intraday basis, but we reversed and put in a bearish engulfing candle. And so I'm actually looking for a little bit of weakness here in the near term, at least down to this rising 20-day moving average. If that doesn't hold, I think we have a reasonable shot to move back down to about 1630 to test the lows at the end of June and to begin July. And that could set up some great opportunities in the small caps, in my opinion. So I'd actually like to see it go back down to the 1630 level. If it does hold at 1670, though, at the 20-day and move back out and break out, that would be a cup handle breakout. And the measurement there would be from roughly 1706 down to about 1630. So that's 76 points. Tack that on to 1706. That would take us up to about 1782 would be the measurement there. So the Russell 2000, clearly worth watching because it has been a relative outperformer. When we take a look at some other areas of the market, of course, the consumer discretionary space, this has been the best area of the market. It's got the highest scooter rank. It has been performing tremendous. Look at the clear breakout in June above the January high. We went back, tested it, and then came back up again, but got close to resistance. And I'm going to go through and show you a number of industry groups within consumer discretionary. And I think maybe you'll see why the market is having some issues today. Let's first start off with the toys, DJUSTY. Check this out. 2 days ago, we hit resistance. We're backing off of that key price resistance. We move on to broadline retailers, one of the leading groups for quite a while. Set that high back in mid-June, pulled back. We've moved back up, but we're testing overhead resistance. Very difficult just to keep moving higher when you've got a lot of sellers recognizing these key resistance levels that are out there. Let's move on to the specialized consumer services. Here we had essentially a double top in June, right around 1560. Right now we're at 1567, trying to get through. Next up, publishers. And keep in mind, again, these are all industry groups within the consumer discretionary area. Look at all the tops here, close to 370. Where are we sitting right now? 369. Very difficult to try to get through. Even some of the groups within consumer discretionary that have underperformed, like the restaurants and bars, straight downhill, PPO accelerating to the downside. We move up. All of this support for a few months was between 1440 and about 1450. Well, that 20-day moving average was sitting at 1444. We went up, tested it, and we're rolling over in the restaurant group. Then you look at hotels. Hotels, same thing, putting in a shooting star candle off of an uptrend, but looks like we're rolling back over to the downside in this group. The DJUSRS, which are your specialty retailers, got up close 2 days ago. This includes stocks like Netflix. Netflix just recently tested its all-time high. But here you've got the specialty retailers coming up, kind of completing a cup and pulling back. Looks like maybe a handle forming here. And then you've got a negative divergence on one of the strongest groups this year. You've got the apparel retailers as we moved up, tried to break out again, actually had a higher close, lower PPO. And on that close, look at the volume. Nothing like what we saw on the move up. So I think this is a group that seems to be running out of steam, at least in the near term. If it closes back below 930, I think we're going to get a 50-day test here. And then the final one, and we've talked about this group a lot, media agencies, that 590 level on the weekly chart, we actually closed at 591 yesterday. Looked like maybe we're going to get a breakout, but remember, that's on a weekly chart. So on the daily chart, we closed above, but look what it looks like on the weekly chart here. We need to get through 590 on a weekly basis and hold it into the close. So hopefully this kind of paints a picture. There's a lot of areas within consumer discretionary that are at key levels where many times you'll see a pivot and a reverse. And unfortunately, I think that's what we're seeing right now, not only on the small caps, but also in one of the strongest areas in the market, consumer discretionary. We do have a number of upgrades and downgrades. So Erin, why don't you go through those for everyone?
All right, let's take a peek. All right, I have 3 downgrades and 2 upgrades. Twitter is going to be included here. So I know that always gets requested for the 10 and 10. So we won't need to go over it because I'm getting ready to go over it. Let's go ahead and start with those downgrades. Pan American Silver Corp will be the first one I'll take a peek at. And I did actually get these annotated for us. All right, so obviously on the downgrade, investors not liking it. We're getting a drop. It's testing that 200-day EMA. You can see the PMO is turned down below its signal line, and honestly, it had already done that beforehand, before this big drop. So we were already getting some warning that momentum was stalling out. You can see with OBV mostly flat, and look at that scooter just falling quite far. I don't know that this would be an opportunity at this 200-day EMA. It's a possibility, but with momentum looking that ugly and not seeing that much action here on the OBV, I wouldn't be looking at this as a possible bottom feeding opportunity. AT&T, you can see it's hit overhead resistance at this short-term these tops back in May, and it was turned away. We actually got the breakout and it closed above, but today moving back down on the downgrade, but not getting hit that hard, 1.25% decline. We're still on a PMO buy signal. It is below the zero line, but it is still rising. OBV still looks pretty healthy. I wouldn't be too worried about this one. More than likely, we're going to hold that 20-day EMA and form a bit of a flag possible here. So even though we're seeing that downgrade, I'd like to see that breakout. That would give me some confidence at this point if we could get back up and test that high that we got yesterday. Let's look at Twitter. Like I said, also downgraded today. There are some big problems on the Twitter chart, and I've been watching these for quite some time. The main one being this PMO sell signal that happened at the end of June. So again, we were starting to get some warning that momentum was beginning to fail, and it's continuing that, as you can see. We're still sitting very high as far as the intermediate to long term when you look at the scooter value being above 99, one of the better performers, obviously, among large caps. But what I'm noticing right now here is this descending triangle. This is a bearish formation. I would expect to see a breakdown here. And we need to hold this area. That you can see back here, we've got gap support that it's sitting on right now as well. So I suspect we're going to get that gap closed. We probably will move down a bit lower. If you really want to look at this as a reversal pattern, you would look at the height at the back of this particular formation, and that would tell you about the height or the length of the decline. And that would put us right here at that March top. So I think there's a really good chance we're going to see a pullback here in Twitter. I would, if I were holding it, I would be watching very carefully that gap support. All right, two more to go. CONN cons. This one, we have overhead resistance being tested right now, and it's pretty serious overhead resistance. And you can see it has been turned away even on this upgrade. And I would be a bit concerned about that. The fact that with that upgrade, we weren't able to get above that overhead resistance. PMO looks okay. It's flat, which tells me that, the acceleration coming into this was pretty steady, because it does measure acceleration, not necessarily speed. So we're seeing that it was mostly flat. We're sitting overbought. I don't see this as a good opportunity, even with that upgrade. And finally, the final one was an upgrade right here with Myriad Genetics. And on this upgrade, clearly having a great day, up over 14%. That also managed to yank the PMO upward because it wasn't heading that direction earlier. OBV looks pretty healthy. And of course, the scooter is now moved quite high, but I would wait for some sort of pullback here. Obviously, trying to jump in here on this giant move, probably not a good idea, but I could very well see a pullback towards that 4150 level to test this area of support at that January high. And if it can hold that, I would look for it to go higher. And that's all I have for the upgrades and downgrades. And I think it is time to bring back our guest, Tushar Chande. Welcome back.
Yeah, welcome to the show, Tushar.
Thank you very much. That's fantastic. And thank you for having me back. It's really wonderful to be here. And I was able to, is my slideshow on? Good. All right. So
All righty. There we go.
Sorry about that. It always takes me a moment. So what I did for today was I talked to Tom yesterday, and he had some suggestions. So I'll run down. I'll show you what my topics are for today, and mostly I'm going to be touching on financials, US dollar, and my market forecast for the rest of the year. You can follow along with me on my trend check blog on the stock chart side. One of the things that Tom did was he had a post this weekend talking about relative strength as a way of looking at for picking stocks. And he had an example of something that had high relative strength and something that had low relative strength. So I'll show you a plot that makes it a little easier to work with. And then he had a question on financials. And so we'll talk about the path of least resistance for financials as a group, and particularly banks, because their earnings are coming up this weekend or this weekend on Friday. A brief look at the US dollar. And then I'll touch on, are we going to have a summer rally, and with all the news headlines, that's certainly a bit of a challenge. So what I have here is a plot of Scooter on the vertical axis and my Chande trend meter on the horizontal axis. So the y-axis Scooter is like a relative strength, relative performance measure, and the horizontal axis is like an absolute performance measure. So you're simultaneously comparing relative and absolute performance. And the two stocks that Tom touched on this weekend was NEWR and PSMT, and you can see that the one he favored, NEWR, had a relatively high Scooter value and also a relatively high absolute trend strength. And then PSMT is low in terms of relative performance as well as trend strength. So this plot is an easy way to look at the entire universe of stocks and ask yourself, what is your trading strategy? If you want to trade momentum and breakouts, you'd be in the upper right-hand corner. If you want to be counter trend, you'll be in the lower left-hand corner. So that's an easy way to look at it. And this week I talked earlier about MKC and McCormick's, which is kind of a defensive play. And it had a nice breakout. Now it's consolidating just a little bit. But the point here is that as a result of the breakout, it had very high absolute strength and very high relative strength. So that's the kind of breakout that I like to look at. So this is one chart where you can look at a large group of stocks, plot relative strength on the vertical axis or relative performance on the vertical axis, and absolute performance, or what does the chart look like on the horizontal axis. And then you can pick, say, a value is greater than 80 or greater than 90 to help guide your trading. So this was I thought, somewhat easier than doing lots of comparisons, because it gets harder to plot multiple chart points. Okay, so the next topic I want to touch was financials on their path of least resistance. In particular, I was looking for the KRE and the stocks that are that's the regional bank ETF. And what I did was I looked at all the stocks that are in the KRE, and I asked myself, what is the distribution of the RSI values? So I broke the RSI value, the 14-day RSI, into three ranges. More than 70, they would have a lot of momentum. Less than 40, they'd be weak. And between 40 and 70, they'd be neutral. And the gold line represents the percentage of stocks that are between 40 and 70 have sort of not really any great momentum. The blue line is the one that are more than 70, so they're trending up strongly. And then the orange line is the one with the RSI less than 40. So you can see that the vast majority of stocks, that the gold line is near the top, almost 100%. So that tells you that the majority of the stocks in the KRE have no upside momentum. So as a group, it's really very flat. This is another way of looking at the KRE, and which is the dials on the lower level or at the bottom. And I have 4 time intervals. I have short-term, medium-term, intermediate-term, and long-term. So starting with 25 days and going up to 200 days, doubling each step. And I simply applied a trend following model. And I asked the question, is it bullish or bearish? And how many stocks are bullish or how many stocks are bearish? So if you look at the lower set of dials and the short-term environment, just about everything is bearish, which is consistent with the very low levels with virtually no stocks with having an RSI more than 14 or RSI 14 more than 70. And then if you go from left to right, Whether you look at the short term, medium term, intermediate term, they're all negative. Only the long-term environment is on the whole positive. And if you look at financials as a group, which is the upper set of dials, you have essentially the same picture. The short-term environment is very bearish for these stocks. The medium-term environment is also very bearish. The intermediate term is also bearish, and the long term is negative as well. So at the moment, there's very little momentum in the financial stocks as a group and in the regional banks as a subsector. So this is something that, unless you're a counter trend trader, is really not that interesting to look at. The next chart shows you the US Bank Index, the DJUSBK, and my trend meter is on the lower panel. You can see that it's just come up to 46 after being down near in the red area below 10. So which means there's no momentum. If you look at the breakout, we had a resistance around 440 that we broke out of, and since we've been coming down, retesting the breakout point of support, so we have this very large descending triangle. So this is again consistent with the prior two slides where we have no momentum at all in this sector. So you can decide whether you want to be a counter trend player and maybe buy the lows or the retest at 450, looking for a breakout above the triangle. But as a longer term player, I would just wait till I get a breakout in the whole sector above 520, because I don't know how long it's going to take, and I'd rather not trade it. So from a momentum point of view, I can't really make a strong case for being in the bank stocks. But if you're a counter trend player, then you say, okay, well, there's some good value, maybe I'll look at it. So that's sort of my view where the bank stocks are going. And what I did was I did a scan for the banks as a group where I asked the question, just rank them by the trend meter. The right-hand column, the extreme right-hand column, is a daily Chande trend meter. So the higher the value, the stronger the uptrend. So a couple of things to notice here. There are only a small number of stocks with a value more than 90, which is pretty good. But you see that there are some blank spots for the scooter but I have values in for the trend meter. So this is just an example where the scooter values are not available for everything, but they are available for the trend meter. So the trend meter is a convenient tool for you to use as an alternative, sort of a momentum ranking process. And even within the sector as a whole, which is not really trending very well, there are individual stocks that do have some trend strength. So again, if you're really interested in the sector, you think maybe it's come down in support, it might get a bounce later on this year, then you can use a trend meter scan to try to identify the stocks that are still trending well. So if you like the sector, you still have a way of trying to find the strongest stocks within it. So this is sort of my approach to if you want to trade the sector. The next thing I want to touch base on was the US dollar. Now, the next chart shows you what the dollar has done for quite some time. You can see that in the last several years, there's been this well-defined blue line or downtrend, which the dollar seems to stick to. And then this year, we've had the breakout past the trend line. We've had a pretty significant rally up into the 25 area. And then another question is, what's the dollar going to do next? And if you just look at this chart as a whole, you see that once there's a breakout past the downtrend line, the uptrends have persisted for some time. So and you can also see that it has come up into some resistance. And if you look at the trend meter down below, it's about 67, still in the green area, but showing some loss of momentum down from the high 90 values. So clearly, there's been some resistance that the market has run into, but I would have to say that the longer-term uptrend is still intact, and you might get some consolidation. So then what kind of consolidations can you get? So you could make the case that if you look at the dollar, you might get an inverse head and shoulders type of pattern. You can see that I've drawn the resistance at 95. And if you go further left all the way across to, say, late 2016, you can see there's some support. There's some support there that the market used to bounce higher. So the 95 level is a good level of resistance. And you can see that we have a pretty well-defined left shoulder and a pretty well-defined head. And now the question is, even if you do have a pullback, are you going to come back and retest support at 91 and maybe form a right shoulder before you continue higher? So now there are a couple of macro issues. One is that the Fed is going to continue raising rates. So as long as US rates are rising, short-term rates are rising, the dollar will be attractive. At some point, Europe will have to also start raising their rates. So eventually, when they get around to it, the interest rate differentials will start narrowing between on the short side between Europe and the US. So euro will become more attractive once they start raising rates. So the dollar also will be influenced by the monetary decisions in Europe in particular. So we don't know when they're going to do it. There's a fair amount of chatter about how they're going to start raising their short-term rate pretty soon, maybe next year and so on. I don't really know, but you can make the case that maybe this will be just an extended consolidation to the right-hand side. So I think it's safe to say that we've hit some resistance. There's a potential for it to come back and maybe form a right shoulder. And of course, we don't know what the big central banks are going to decide, and they'll of course have a large role in influencing short-term rates. So that's kind of where I'm with the dollar. I think the bottom is in place, the uptrend is still intact, but the market might consolidate here for a while because they've hit some pretty decent resistance at 95. All right. Then a topic sort of near and dear to me in terms of, are we going to have a summer rally? So I had written a post on this some time ago where I only use a Dow for the reference. And the traditional measurement is to use a Dow because obviously we have a lot of data on that. And typically the logic is that we get about a 13% rally from the May lows into the July, August, September highs. And at the time that I did this thing, we were about 7.6% up from the lows in May, and of course we've had a pullback since then. So the question is, are we going to follow through and have a summer rally this year? So of course, I think we'd all be quite excited if it did. I'd be happy certainly, but it's not quite clear that the Dow is going to make it all the way. So that's the question. Now, if you pull back a little bit and look at the other major indexes since the May lows, you see that there has been a summer rally, but it has been really in the small caps and in the technology-laden NASDAQ. So it's not that the stocks have not rallied, it's just that the Dow has been lagging, particularly the small caps. And the small caps have been responding to the dollar as well as the fact, or the trade wars, because most of the companies in the small cap space have almost all of their earnings only from the US. So if you look at this the last few days, I went back, looked at the Dow. Of course, today is a different day, but we have this triangular consolidation forming, and then the market broke out late last week and earlier this week. So we came off the lows. So I would say that on the 60-minute chart, the CTM is up near 80s. You could make the case that market could pull back and retest the Bollinger Bands at some point, but there's an uptrend, and I think that we could probably still muddle higher. And of course, once the earnings kick in, I think the market will have more to go on. So I'm hoping that despite today's pullback, the market will digest the headline risk and focus on earnings and keep working its way higher. Of course, we don't know exactly what it's going to do, but I think short term, even the Dow has a chance of heading higher. Tom already referred to this chart. Mine is from last night, just to show that Caterpillar is really the poster child for the effects of the trade war headlines and for all the trade war worries. You can see that the big red bar on the left-hand side was really their earnings call when they said that earnings may have peaked because they were going to spend a lot of money doing infrastructure development for themselves. The market only heard earnings may have peaked, and we had this big sell-off. And then in June, the sell-off was primarily headlines related to trade. So again, today I know it's down a little bit, maybe down in the 138 area. But this is a good thing to watch in terms of seeing the effects of the trade war. And of course, it's in the Dow, so that certainly has an effect on the Dow itself. This is, again, something that, this is the XLU chart. Again, you see it had a pretty strong risk-off rally in June when the market sold off. And then we had this very huge retracement bar, kind of broke the uptrend, broke below the 10-day moving average, and then it's rebounded a couple of days. So the question is, are we now in a risk-off mode or a risk-on mode? Unfortunately, I can argue both sides of the coin here, so it's a little hard for me to tell precisely. But I think the very large bar down tells me that we are more in a risk-off mode than a risk-on mode. So that remains. I would love for the XLU to go lower, if you will, so that that would tell me that it's no longer is more of a risk-on market than a risk-off market. But certainly, the one-day sell-off tells you that the market wanted to go higher and aggressively reduce positions or exposure to utilities, the defensive positions. But on the other hand, we've had a bounce for the last couple of days. So, is it the end of risk-off? I certainly hope so, but I think the last 2 days have certainly changed the picture a little bit. This is a little bit broader look at the broad market, the NYSE index. My big concern all year has been that the NYSE has been lagging quite significantly. This is a 60-minute chart, so we can take a little bit greater look, closer look at what's happening. You see that the downtrend line defined by the initial sell-off has also helped contain the subsequent sell-off regions. So you can see there's been parallel channels, if you will, that have contained the sell-offs that also reflect the downtrend line in the big picture. The resistance is pretty clear. We've had resistance in the 1200 to in around 12,800 and then all the way to 13,000. So I think that we're not going to get a significant summer rally until the NYSE can break out or at least reach 13,000 and above. So even though there's a lot of backing and forthing, and I think there was an article in CNBC on how only 3 stocks, Microsoft, Amazon, and Netflix account for virtually all of the gains, 71% of the gains in the S&P and 78% in the NASDAQ. So extremely narrow market. And I think this just shows you that the broad market has really just been going sideways. So the double bottom is in place and has simply not been able to rally significantly. So I think for me to be convinced that this is going to be a sustainable summer rally, I need to have the NYSE break through this resistance, which has been quite formidable as if you look across this chart. In the short term, the 200 stochastic RSI is back above 0.8, which tells me there's some upside momentum, but the resistance still needs to be overcome. So this is a good reference if you want to ask the question, is the market really rallying and getting ready to rally? Same picture for the S&P 500. This time I have a 2-hour chart. Again, a 200-bar stochastic RSI is bullish. Market is up against resistance around 2,800. We worked our way past the double bottom. We found some higher lows type of chart. So you can say that you could draw an uptrend channel if you wish. But again, same problem until we can break out above 2,800 and hold it for at least a week. I think I would still not be convinced that the market has broken out in a significant way. This is just some doodling more than anything else. So if you just look at the last few, what I did was starting in April and May, I put a little parabola to show the chart, to show the pattern. I just copied it over 3 times. And you can see that the price pattern has roughly followed the parabola. You can see that it is the uptrend. Now the question is it going to go all the way to the top of the trend channel, or is it going to roll over like the parabola suggests? And then what I did was I calculated the price moves for each of the rebounds or each of the moves higher, and I said if I use that count from the low in July, where would I end up in terms of a price target? So I got price targets all the way from 28.15 out to 28.55, depending on whether I took the average value or the average minus 1 standard deviation and so on. So this is again, I think, a useful visual of what the market is trying to do. It's in some kind of uptrend channel. It's in some. It has sort of a wave-like lurch higher, and we have tremendous resistance overhead all the way up to the highs in January, and certainly. We've seen that there's resistance for the broad market in the NYSE. The Dow is nowhere near its resistance from say March. So the market is kind of moving higher, but really narrow. So, and of course, we know that the rally has been in the short, in the small stocks, small cap stocks, and in the tech stocks. So interesting question. It'll be interesting to see what the viewers think, whether there will be a summer rally or not. So this is sort of a look at potential S&P targets if there is an upside rally for the next little bit. And I'm going to wrap up by showing you the forecast that I did in December, and I said that I expected 2018 to be flat and volatile, and I think we'll all agree that that has been quite an accurate forecast. And then what I did was I made this price projection. Where the orange line is that I expected month by month, and you see that the blue line, which is the actual S&P 500 performance, has been not too far from my projected line. What's quite fascinating is that my year-end forecast of 2750 is actually maybe more pessimistic than everybody on Wall Street. The Wall Street consensus is around around 3,000. Essentially, what's happening is that the year-end S&P earnings are on the order of $155 to $160. So now it's strictly a matter of what price multiple you want to use to project your prices. People are using numbers between, say, 17 and 20. So I don't know what it'll be, but that's how they get their range. And of course, if you look at the bands that I've drawn, any value within, say, between the dotted line and the solid orange line will still be within my forecast. So my view is that we can probably, going into the election, generally August, September, October will be flat this year. Again, another volatile election. We don't know what the results will be, and I'm sure the results will have a big influence on how the rest of the year ends. So on the whole, I think I'm rather cautious. You see that the NYSE has not rallied. My forecast is essentially flat or slightly higher, maybe a little downdraft going into the election season. So that's kind of where I am. That's why my forecast may be more pessimistic than the rest of Wall Street, and still not convinced that we're going to get a significant breakout unless we can get about 2,800 on the S&P. So that's what I have, Tom. Happy to take questions or hear your comments. See what you think.
Okay, well, I clearly think you're more cautious than I am. I'm definitely more in the bullish camp. I still think the market goes higher, but I do have a question for you because you are cautious. How do you approach the summer months? I mean, we know that the summer months historically are not as bullish as, the rest of the year. So, when you talk about the summer months, you talk about being a little bit more cautious. How does that change your trading strategy? Or, I mean, do you hedge? Do you get into more cash? What do you do?
Mostly, right now, I'm still fully invested. I'm waiting for the market to go higher, but I'll use a trend meter to find the stocks that are that have momentum. I'm a momentum trader, so I will use a trend meter combined with other things that'll tell me where the momentum is. So the market will tell me what they want to trade for the summer. All else fails, I'll get out. We are going to ChartCon, and then I believe there's a cruise to Alaska, but I'm sure I'll not have any cell phone reception. So I'll probably be quite defensive then. But other than that, I think just as a trading strategy, I would be cautious, but I'll just trade whatever has momentum. I'm not choosy that way.
Yeah, that brings up some really bad memories for me, because I remember back in 1987 during the crash.
Right.
I got married right before that. I was on my honeymoon. And of course, back then, it wasn't easy to just, pick up your cell phone or, go on your phone and make changes. I mean, you couldn't do any of that stuff.
Nope.
So I literally was out of the country and out of pocket, and I left my portfolio in play and literally came back. I think I had about 25% off. I think it was a 25% off sale in my portfolio when I got back from my honeymoon.
Well, I have been trading for a very long time, and I've discovered that somehow the market knows when I'm not at home and on the road.
I think it does. I think they send signals.
Absolutely agree. I was moving my daughter into university, and I had a huge position in the metals at the time, and it was like as soon as the day after I traveled, and I didn't have access. I'm moving her into her door, and I got hosed.
It's magical. The market knows exactly what you're doing. As soon as they know you can't do anything about it, they're going to reverse on you.
Mm-hmm.
Okay, well, I got another question for you. As you look, looking at your trend meter and all, what are your favorite areas right now? Going through the summer, and does history play a role at all, or is it strictly based on what's happening right now, based on momentum?
It's strictly the trend meter. I know the historical this and that, and this group has done well, and that group has done well, and they all have value. I'm not saying they're wrong or anything. All I'm saying is that the market is already making the decision for me. They're putting their money where they feel the trends are going to be. So my job is to just identify the trend and go along with the herd, if you will. So I'm not going to prejudge if this group is growing and that group is growing. But if I do a ranking by Chande trend meter, the strongest stocks will be at the top. So it doesn't matter what sector they're in, and so it'll automatically tell me where I want to go.
Okay, fair enough. Now, again, I think I know what the answer is for you technically. because stocks like Caterpillar have really gotten hit hard recently, and obviously their momentum has been to the downside mostly. But I mean, I guess maybe from a gut feeling kind of perspective, do you think that the pullback in some of these big names like Caterpillar, is this presenting an opportunity, you think, for down the road, or do you think you really should just sit back and wait?
Yeah, you should just sit back and wait, in my opinion, because the trouble is that so the value is a very squishy concept. If you think of Exxon, right? It was or Enron rather, when it went from infinity to zero. Everybody loved it at 100. They couldn't get enough of it at 80. At 70, they were buying by the bucket, and at 20, they were broke. So once a market starts on a downtrend, I don't want to get ahead of the downtrend unless I feel really strongly about, or I'm trading very short term, and maybe a few days bounce will be sufficient. As an investor, now there are two contrasting views. If you're an institutional portfolio guy, you got zillions of dollars coming in every week. I said, okay, sure, I'll buy it. I don't care. I'm going to hold it forever. So it makes no difference. That's a value player. But if you're an individual, then I would just stay out of it. Why bother? There's so many other things trending higher. Why do you want to guess where the bottom is going to be in Caterpillar?
All right, point well taken. And in fact, I'm going to go ahead and show my chart that I have on this. I want to kind of get your comments and maybe let everybody take a look at this. But this is a chart of Caterpillar going back the last 2 decades on a monthly basis. And so you can see, obviously, we made a big breakout. We had topped in 2008 with the market getting hit. We finally came back up. We broke out in 2010, had a straight up move. I mean, this is from 60 on the breakout. We broke out just above 60 and traded up near 100. So that was a huge move in about 6 months.
Correct.
And notice what happened afterwards. We ended up coming back down and testing the area of the breakout. I mean, this is just technical analysis 101. Where your prior resistance becomes support.
Right.
And Caterpillar traded in this range for a number of years. And recently, we had another one of those 6 to 9 month run-ups on a breakout.
Right.
And if you look at the chart, I mean, it says, maybe this is the start of a period of weakness on Caterpillar that could take us back to 100.
I think it's a pretty fair analysis. And I think that's how I would also look at this chart. Imagine if you look where your first left-hand arrow is, when it first came down to 60. Suppose you said, oh, I'm going to buy it over there. Well, it was a good buy, but you had to wait for a very long time before it really had any significant move higher. So that's my hesitancy in buying or being a counter trend purchaser, because I don't know when it's going to rally and continue going higher. Whereas once it starts going higher, I know I just have to have the patience to hold it and absorb some volatility. And I don't have to guess when it's going to start moving higher. So I'm sort of more conservative in that way, or I'd rather have a breakout than be an anti-trend trader. But strictly from looking at the chart, I would say the next really significant long-term buy point is 100, obviously. It'll a retest of that breakout.
Mm-hmm. Yeah, I would agree. I mean, I don't know how exactly we get there. Maybe we go back up and hit 160 first and then pull back. Maybe we never go back down there, but you and I both know that many times technical analysis, you think a stock can't possibly go back to a certain level, and it does, especially once the momentum fades on the stock, like it has on Caterpillar. We did have a poll, and I wanted to go ahead and bring that up if we could. We were polling the audience to see whether or not they believe we're going to get a summer rally this year, and so I'm kind of interested to see the majority at this point saying no. Well, not the majority, but the highest percentage. 44% going with no, 33% saying yes, and 23% are kind of undecided. I think that's kind of about where you're sitting, I'm assuming, Tushar.
Well, I think that, yes, I'm sort of sitting there. I want the market to rally, but let's just say that I'm hoping that the earnings season will be a good season and it will push the market higher. In a way, it's good that people think that it's not going to happen. That actually increases the odds that it will happen. So this is a contrarian sort of view. So I'm actually happy that most people think it's not going to rally, which probably means it's going to rally.
That's right. Sentiment being contrarian.
There you go. One of my favorite themes going forward are the banks. I actually think that the banks fundamentally, I'm waiting for the technicals to agree with me. And so I don't own any banks right now. Right. But I think interest rates go higher. I think we're in a period of deregulation. I think there's a lot of positives for the banks out there right now. But I'm not seeing it yet on the charts, other than the fact that they've been holding that support level, I think that you alluded to earlier. Other than that, there isn't a whole lot of reason to get excited behind that group just yet. And we've got a lot of key earnings reports coming up in 2 days.
Yeah, the problem for banks is that the spread between the short end and the long end has been coming down. That's where a lot of their money is made. So if the spread shrinks, they make less money. So that's why they've not been getting any significant bids. It's not clear that the spread is going to start increasing anytime soon. So now you're back down to a business that's not really making money, lending money, and then you have to wait for the fees and so forth. And the fees and so forth are important, but maybe not as crucial as the spread. So I think that the banks and the bank earnings, but the tax reform is going to help bank earnings. So the bank earnings should be good due to tax reform effects, but not necessarily to fundamentally a favorable lending environment. I think that the market is telling you that the banks are not going to go higher for some time, because otherwise they would be higher already.
Okay, fair enough. Well, it was great having you back on today. We certainly appreciate your updated, narrative on what you see in the markets throughout the summer and into the second half. Always have a great time having you on here, my friend.
Thank you so much, Tom. Thank you, Erin, as well, and look forward to seeing you guys here for ChartCon.
Absolutely.
And thank you, Erin, for tuning in, of course.
Yes. Yeah, getting excited for ChartCon, that is for sure. Can't believe, what is it today, July 11th, right?
Yes, we're almost exactly a month, well, just under a month away.
Yeah, what are the presentation days again? Is it the 10th?
10th and the 11th.
So I'm presenting 1 month from today.
Yes.
Yes, I'll be looking forward to that. That should be really interesting.
Indeed.
My presentation or ChartCon?
Both.
Oh, you're too kind. All right, it was great having you on, Tushar.
Thank you so much, Tom. Thank you again.
All right. And there he goes. I always appreciate having Tushar on with us. All right, ready to get into the 10 and 10, Erin?
I am ready to get into the 10 and 10. Let's go ahead and take a peek at the RRG here that we have. Okay. So you can see that really an interesting movement here, I think, for our 10 and 10 requests. There are a lot that are trying to move up into that northeast direction. So looking forward to looking at a few of those. And then if you look at the sectors, really cyclicals and healthcare seem to be dominating the requests. So I will definitely be looking at a few of those. Not a lot of requests today, and that I always think of the fact that people are just so interested in the presentations that are going on that we just don't get a whole lot of requests. But the next symbol will end up being the most popular in the chat room. Currently, Alibaba is winning with Amgen right behind it. So let's go ahead and get started with Tencent or Tencent Holdings.
Yep, Tencent Holdings. It's in the internet space. And so this is what's kind of got my attention on this stock. Number one, it's held support so far. So from a longer term or maybe more intermediate term perspective, I'd really watch $47, $48. If we lose that support level, I'd be pretty concerned about it. But what bothers me is that over the past 3.5 months, the internet stocks have really done very well. We've had periods of pullbacks, but really over the last 3 months, they've done extremely well. And if you look at it on a relative basis, because the stock Tencent's been coming down over the last 3 or 4 months while its peers have been going higher. And what that translates into is a stock that just has an awful look to it from a relative perspective. So I want to see stocks that are leading, and you see all of these lines moving up on the right-hand side to the upper right corner, kind of like their peers are. But I'm not seeing that really anywhere other than with the peers. So if I'm looking at Tencent, I'm probably going to say, no, I want to stay away from this one. And I want to go with something else in this space because the space is good. Just unfortunately, Tencent has not been good. So especially if we lose support, there's no reason why the stock should be losing multi-month support when the overall index is moving higher. So I would keep a real close eye on 47, 48.
All right. And the most popular in the chat room is Alibaba. That did make it.
Okay, Alibaba, well, I think short term, and this is a little bit, I'll allude back to a little bit what Tushar was talking about. When you got a stock that's not performing well on a momentum basis, it's really difficult to get behind it. And just in the short term, we looked like we were breaking out back in early June. But with that double top, we did have a closing high where the PPO rolled over. We went down. We didn't even hold the 50-day moving average. We went through it. And what's really disturbing is that the volume picked up on that loss and so far failing at the declining 20-day moving average. So for me, it's just watching this 20-day and then perhaps the the bottom of gap resistance right here at 197. So I think the stock, Alibaba's got two problems ahead. One at the 20-day moving average where we just failed, and then again up at the gap resistance level near 198.
Okay. The next one, let's see, since it was close, let's go ahead and look at AMGN.
Yeah, AMGN actually was one of the stocks I really liked heading into July. It's a biotech. Biotechs love the month of July. Don't ask me why. They just do. Maybe some of it is money moving a little bit more toward the defensive healthcare space. Maybe they have, I don't know this for a fact. Maybe there are more announcements with the FDA over the summertime. I don't know what it is, but this is a group that does very well in the summer, especially in July. Amgen is one of the top performers in July. And you can see that since the calendar month flipped from June to July, it's like we have a different stock here. Amgen's been moving higher. We did hit some resistance. I actually was in the IBB and I saw a number of stocks getting close to resistance. I actually sold just to take profits because the overall major indices were getting close to a resistance level. So I've gotten out of all of my biotech stocks for now, but I am looking to get back in on weakness. I think Amgen, you've got a couple levels here. You can see that close that we had about 195 and then that tail from back earlier in the year in January up near 198. I think that's a key resistance area. We got into it yesterday and now it looks like we're reversing. So far during this uptrend in July, we put in higher lows every day. Right now today, it seems like we're testing yesterday's low. I'd be tempted to take some profits from a short-term trading perspective. Longer term, I'm a big fan of Amgen. I think it goes higher longer term.
All right. Groupon, GRPN. I know I've stayed away from it. I don't know how it's doing.
Let's see. Groupon, yeah, it was kind of weak. This is one that I'm going to go back a ways. It just, I wouldn't trade it just because it seems like every time it gets a little bit of momentum going, the carpet gets pulled out from under you and then, and then it starts to rise again. And then you see the same thing. I mean, you can see the gap up here. This is 2 years ago, back in 2016. Gap up, going straight up, looks great. And then a few months later, a massive gap down. And you lost all the gains. Went down for several months. Then you get a gap up. Then we come back. We get a little bit of a rise, another gap down. And so this just kind of seems to be the history of the stock. If you look back over the last 2 years, we've had a great rally in the market. Groupon is about where it was 2 years ago. So I'm not a fan. I can't really get behind this stock. Short term, it looks good for a while, and then all of a sudden it falls apart like this period back here in February 2017. I don't know where this thing goes from here. Looking at it from a technical perspective, it should have some really good support just below 420. We've certainly seen that tested on multiple occasions this year. And I think the gap up in that black candle right here, when we pulled back, I think that sets a pretty key resistance level. So we're kind of in the middle of a trading range between 410 or 415 up to about 540. I think the history of the stock tells me just to stay away.
Okay. Let's see, the next one I have for you is from Consumer Staples, and I am a Lauder girl, Estee Lauder EL.
All right, EL looks really good. We did get the gap down on heavy volume where we managed to break out. Currently, we're pulling back below the 20 days. So I like the longer term chart. I just don't like getting in at this point. I think this is another case where perhaps we're going to go back down, maybe establish what could be a neckline in a topping pattern. I don't believe that to be the case because I do believe that we are in a bull market. So I'm not really looking for topping patterns, but I wouldn't be surprised to see us go back maybe close to this level. That is the major area of support on Estee Lauder, 131 or so. We've had multiple bottoms down here where we've held. We had a prior high before a breakout in January at that 131 area. So the stock currently is at 139 and change. I think you've got more downside possible here. And the PPO is very weak as well. So I think I'd hold off and see if I could get this one into the low 130s.
Okay. After Estee Lauder, we have VRX. And that, of course, is Valiant Pharmaceuticals, more healthcare.
All right, let me shorten this chart. I don't think we need this long a chart on all these stocks. Okay, well, we had a pretty big breakout here after going sideways, had a nice move up, little flag, and then a breakout. We went all the way up to the 27, 28 area, and then we've started this descent. But I really would look for maybe 22 to 22 and a half to hold here on VRX. So I'm going to look at this level right there. That was the prior high before we went into this flag pattern. Then we broke out, check out the volume picking up as we made the breakout. And now we've come all the way back down close. Well, we gotten into the 22s. Maybe we haven't quite gotten to support, but pretty close. I wouldn't be surprised to see another trip back down to test this 22 and a quarter area. And I like it much better at that level. The PPO now has gotten all the way back down to the center line for the first time in a couple of months. That's a positive as well.
Okay. Next one up, we've never looked at this one, HXL, Hexcel Corporation. It's aerospace industry.
All right, HXL. Let's pull this one up on the relative chart. I bet this one's been doing pretty good. Although, yeah, aerospace still continuing to sideways consolidate. Here we did get a breakout, though, when the overall group was struggling. And so that did result in some strength relative to its peers for a while. I think it's still trending higher, even though it's weakened a little bit in the near term. I would expect that you're going to continue to hold gap support around 64.5 to 65. So let me just kind of draw where that line comes in. Right. Whoops. Not what I want. Let's try this again. Right about here. You see, this is where we were prior to this gap up. Look at the volume on this gap. We came all the way back down, almost filled, went to new highs, came all the way back down, almost filled, and now it looks like we're rolling back over again. I think the best area of support on this stock is just below $65. You could build a position, maybe using two levels, 65, and then maybe again around 63. I'd keep a closing stop around 62 with my target up closer to maybe 73.5.
Okay. The next one, Tandem Diabetes Care Medical Equipment, TNDM.
Yeah, this one was on fire. Yeah, it still is. Really great chart in a very good industry. So this one, you're going to see exactly what I was talking about, where everything on this relative chart is pointing from lower left to upper right. And that's how you make money in the stock market. Now, eventually, this thing's going to run into trouble. It hasn't even closed below its 20-day moving average in the last 4 or 5 months. Eventually, we will see that happen. And that's when we could run into some more difficulties. But I think, again, looking at this chart, I think that the gap support that it recently had after a heavy volume gap up, I'm assuming earnings related, right here, this would have been June 22nd, very big gap up, extremely heavy volume. We went all the way back down, filled that gap, and now we're back up into the upper end of the range. Now, I think it's a little dangerous buying it here because I do think you're closer to resistance than you are support, so I don't like the reward to risk. But a trip back down into the lower 20s, I think looks extremely interesting here for TNDM.
Okay. And a new one for you on the London Stock Exchange. We have Fidelity European Values, and that would be FEV.L.
All right, FEV.L. Well, I'm going to go out just a little further and see if we've got a major resistance area that we're trying to negotiate here. Yeah, we're getting pretty close to a pretty key level. That January high was obviously pretty important. We've been going mostly sideways. So I would keep an eye on the 229, 230 area, maybe even just above 230 at that tail. That's an area where, for me, I would be taking profits until I could see a breakout to the upside. And to the downside, I think you got to watch maybe these last couple of lows, 218 or 217, and then the one right before it, 214. I think that's your key support on this chart for now. So I think you're in the middle of the range. I'm not really a fan on either side. The longer term chart seems to be more sideways. So I've got some reservations here, but what you want to see is a breakout above 230, 231.
Okay, and our final one for our friends in Canada in the oil and gas field services industry, BDI.TO, Black Diamond Group.
All right, BDI.TO. Yeah, I like the move higher. What I don't like is the negative divergence, but volume is expanding on this move to the upside. So anytime I see prices moving higher like this, and actually we've really had it going back over the past couple of highs where the PPO has been declining on each one of these highs as we move up. Probably could have stopped this around the second week of June. So probably right about in there. I mean, that's where you see the highs and the PPO declining. But the good news is on this breakout, we had solid volume. We pulled back, held the 20-day. And as we started to make a move to the upside, we had good volume. I'd like to see the volume pick up. Now, today it is at about 150,000, and we'll see whether or not, where we end the day. I'd like to see this volume continue to pick up. If the volume is light, I would probably raise my stop to any close below the prior low, or excuse me, that prior high at about 375. If you close back below that level, then I think the risk really grows that you're going to maybe take another push all the way back down to about 330 to test that 50-day moving average and prior lows there.
Okay, and that concludes the 10 in 10 to 1. And here are the symbols that we went over. I will have these up in the Market Watchers Live chart list where you can go and look at all those annotations, copy the charts to your own chart list, and et cetera, et cetera. All right, we'll be right back with the final market update after this message.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.
All right, time for our final market update on the program. As you can see, markets are down and they continue lower. The Dow and S&P, the NASDAQ, all of our indexes that we're following, except for the Russell 2000, gapped down and have mainly continued lower. NASDAQ did try to make a move back, took back some of those losses from the morning, but is back down lower and heading back toward the intraday lows currently. S&P 400 at intraday lows, Russell 2000 testing intraday lows as well. Toronto Stock Exchange, we can see a big gap down and continuing lower, but it does look like we may have found the bottom on the intraday lows for the TSX. We'll have to continue to watch. Gap down for Treasury yields, but moving back up higher, reading at 2.86%. We can see TLT, big gap up, but then headed back down. It's taken back about half of those gains. Now it's testing the gap support that we saw come in. We have UUP on the rise, and consequently, if you look at gold, it is on the decline. Big gap down for gold and continuing lower. The dollar really making a push upward and higher, almost at $25 for UUP. USO, gap down, continuing lower quickly. Just as the dollar is continuing higher quickly, we're seeing USO moving much lower, currently at intraday lows, reading at $14.61 for USO. And the VIX is rising, but we are looking at a reading at 13.67, still not really in the worrisome zone as far as investors go, but we are seeing a little bit of worry starting to pick back up. Wanted to show you very quickly our the decision point ultra short-term indicators, and you will find those as I'm showing you in the decision point live chart list. And let's go ahead and look at the ultra short-term indicators. These are my climactic readings. You can see that we didn't quite get the VIX to touch up through the upper Bollinger Band for for the VIX, and I use this as sentiment. I was expecting a buying exhaustion. As you can see, we had we're seeing a pullback here on breadth for the net advances and declines, and sure enough, we're starting to see some of that weakness. And finally, I went over this chart in my blog last night for short-term indicators, and as you can see, very overbought currently on these indicators. So I am continuing to expect some more weakness and decline. However, when you're in overbought conditions in a bull market, a lot of times those conditions can clear simply with consolidation. So that's mainly what I'm looking for, maybe a pullback to that 2750 area for the S&P 500. And that concludes our final report. And let's go ahead and move on into our final segment, our scooter reports. Did you want to start or shall I?
Oh, go ahead. You got the screen.
All right. Let's do it. Okay, I want to go ahead and go to the member dashboard. This is for our stock charts technical rank, or scooter as we call it. And what I wanted to do was show you how you can get to the scooter rankings right here from your member dashboard. And then what I want to do is look at the candle glance for our top up, the ones that are the biggest movers right now, and see what the candle glance is telling us and which charts I might want to look at in a little bit more detail. All right, so a few of the ones I had on my list, it looks like a few have dropped off, but we'll go ahead and continue on with what we do have. As you can see, Fastenal, we were talking about this particular chart earlier. I know, Tom, at the beginning of the program, but as you can see, we do have a PMO buy signal on the rise here with that move upward. I think you would even note it as well. I would wait for a pullback here, but a nice move to break out above this earlier consolidation from the May-June timeframe. But we are looking at overhead resistance at about $58 just above. So we'll have to see if it can continue higher, but I would wait for a bit of a pullback here if I were going to get into it. So again, these are our top 10 scooter movers. Global payments, GPN, looking very interesting to me because I do see that PMO curling upward and in the process of getting close to a PMO buy signal. So we were already seeing that momentum shift, obviously with the rally that we were getting on global payments. And now we're looking at some overhead resistance here right around that 117 level and currently testing it just about there to get up there to test that. I see overhead resistance on the next level, of course, at 120 at that high in June. And given the buy signal we have, and I'm going to go ahead and annotate this for us real quick here. I want to show you some vertical lines on what's happened previously with these buy signals when they come in. And as you can see, typically we do get some follow through on those. So if we get that buy signal, I would expect some follow through to get it back up here and test that overhead resistance. May want to wait until we do get a bit of a pullback. Today was a 2 1/3% move. So could do for a little bit of a pullback before we continue on. Let's see. Another one that looks interesting to me when I look at our big movers was Campbell's Soup. I saw this one and I thought it looked interesting, mainly because of the possible island or the possible flag. But what I really was concentrating on when I looked at this one was let me get a good setup here so we can see these clearly. I'm looking at this as a ascending triangle, and those are bullish formations, and those typically resolve, of course, to the upside. You'll get above that overhead resistance that it's getting ready to test right now, and the move would be about the size of the back of this pattern. So we'd be looking at a move probably to about the looks like $45, $46 level, and that does come up close to that $48 level of overhead resistance. But I like the looks of Campbell's Soup. I do know it is in the, I believe in the staples sector, so that sector hasn't done that well. But I like the setup here. The PMO is what you might want to consider overbought, but let's see if it actually is. And the best way to find a PMO range is to increase your daily chart to about 4 or 5 years, and then you should be able to tell what the regular range is for Campbell's Soup. So as you can see, we are getting into that overbought territory for the PMO. So we do need to be cautious here because it does have that look of an island, but it's been going so long that I really don't consider this an island necessarily. I mean, usually you're going to see those gaps clear, you know, move back, get closed. So you could expect maybe a downside move there. Not really thrilled with that PMO, I have to say, now that I can see how overbought it is getting at this point. But Campbell's Soup looked interesting, I thought, from the candle glance. Let's go back to the candle glance again. All right, SoftBank, I remember looking at this one earlier. All right. And we've got the PMO buy signal. The PMO is now in positive territory. It is in near-term overbought territory. So just, you know, be aware of the fact that that might be occurring there. But we do have that breakout above the 200-day EMA, and you can see the 20 and 50 are just now making that positive crossover. That gives us an intermediate-term trend model buy signal as far as decision point is concerned. So I like the breakout on this. I think you could even make a case for a double bottom here that has formed. And again, getting that breakout above the 200-day EMA and overhead resistance, I think is very promising here. And there you can see that the scooter moving very quickly to the upside, as well as the OBV. So I think this one's looking pretty good as well. Mohawk was another one that I noticed because we do have a rising PMO and it's now in positive territory, similar to what we see here on SoftBank. So let's go ahead and take a peek at this one, and I will go ahead and annotate this one as well. I want to look at the auto support resistance, and I like mine to be a little translucent and thick, because a lot of times I find that your areas of overhead resistance and support, they will tend to, like you can see right here, we have that low there in March, April time frame, and you have these tops back here from May. And while they're not exact as far as the support and resistance, they're very close. And that's one of the reasons I will a lot of times use a translucent a support and a resistance line, because I find that to be very helpful to be able to see through it as well. And we are getting that breakout. Very nice after this, what you could call maybe a rounded bottom or cup, but you can also see a possible reverse head and shoulders here. There's your left shoulder, head, and right shoulder. And we got the breakout above that neckline. It's a little bit moving a little bit downward on that slope, but we've cleared it, and now we've cleared overhead resistance, 20 getting ready to move up above that 50-day EMA. And as I said, I like the PMO. It's now moved into positive territory. It's definitely not overbought. Would like to see maybe a little bit more strength here, relative strength using that scooter. And the OBV could look a little bit more healthy, but I think this one is an interesting play. And let's see, what else do we have on our candle glance? All right, so Clorox I see, but I noticed that the PMO is topped in overbought territory. So even though we're getting a nice scooter move on Clorox, it wouldn't be one that would interest me that much. I'm going to go ahead and look at it anyway, and then I'm going to pass it back to Tom. See that, see an overbought territory, getting that turn to the downside. So even though we're getting a nice scooter move, we're still not really in the territory we saw earlier this month. And the OBV seems to have hit a bit of a snag. It is trending upward, but not in the healthiest way, in my opinion. And really that decline right now on the PMO and likely sell signal would certainly keep me away from Clorox at this point in time. So those are my scooter movers. And as I said, I just went up here to the member dashboard and clicked on scooters, and then went to my top up just to see which ones are moving, and then clicked on candle glance. So that's how you can get to them and see them in your candle glance style.
Okay, I actually took just a little different approach. I just wanted to look, number one, at the hottest sector, which was consumer discretionary, at least in my opinion. That's been the hottest sector. I talked earlier about the fact that many groups within consumer discretionary are kind of struggling because they're hitting resistance. So I'm kind of looking for a pullback in this space. And so I set up a scan where I'm bringing up only the consumer discretionary stocks. I also set it up so that the scooter is greater than 90, but less than 100. So I'm getting that top 10% of stocks within the consumer discretionary space. And then I changed the volume around just so I make sure I'm getting liquid stocks. So I used a 50-day simple moving average that was greater than 200,000. So when we look back over those last 50 days, we want to make sure that we have at least average volume of 200,000 shares. And that yielded a number of stocks, I think probably about 70 or so. And I've already dropped them down into a folder that I called Scan Results. And first I sorted it by scooter, and then I sorted it by the market capitalization. Now, I'm much more interested in the mid and small cap stocks. I mean, there are some great large cap stocks. I'm not going to argue against Netflix. I think Netflix is a great stock. There are a lot of the larger broadline retailers, clothing, accessories. I mean, obviously, Amazon's been a great performer. Macy's, Under Armour's gotten back in the saddle, moving higher. But I want to focus on mid and small cap stocks because I do think they're going to continue to outperform in the second half of the year. So I have this, all of these set up by scooter rank within the space. So here, your mid cap, this is the highest ranked mid cap stock within consumer discretionary at 98.9. That's Madison Square Garden. But then I further looked for the stocks that are actually pulling back today more than the overall market, and just to see if they're creating any opportunities. So for instance, as I go through, you'll see Lululemon, Wayfair, as I go down the list, Fossil Group, Club. All of these are the ones I'm going to be looking at. So that's how these stocks were picked. Now let's go ahead and take a look at the charts and see if there are any that are setting up or where these stocks might be setting up. Keep in mind, the scooter is between 90 and 100. These are going to be stocks that have very strong momentum, which I'm a momentum trader. That's what I want. So Lululemon, big gap up. This was earnings related. It's been drifting sideways, has really good support at 120 from that prior low. Gap support down around 114 if it ever gets back down to that level. So far, holding the 20-day moving average. I think it could continue to hold here. So I could make an argument for Lulu, but I also realized that I'd have about $5 to the upside. And if I wanted to use the recent price support at 120 as support, I got $5 to the downside as well. So maybe it doesn't make sense unless I use that very tight 20-day moving average as a stop. Next up is Wayfair, ticker symbol W. Problem I have here, check out the higher move to the upside and the PPO rolling over, and also look at the volume that's been waning on this move to the upside. Today, we're getting some selling down to the 20. Maybe we bounce off of it. We do have heavy volume today, but if this closes back below the 20, I think it'll set up for further weakness on Wayfair, perhaps as low as the 50-day moving average as it rises. And I would look for this 105 level as the next key area. That's where we reversed off of very heavy volume just a few weeks ago. Fossil. This one is very interesting because of the negative divergence. Again, big move to the upside. We've seen this over the past few months, but on the latest high, PPO rolls over. We lost the 20-day on increasing volume, had a little shallow move to the upside, and now here we go down again. I think this one's heading for the 50-day. I would avoid it for now. Club I like. This one is testing its 20-day, but it's doing so with the PPO rising. I think the volume on this move to the upside was very strong. To the move back down, look at the volume declining. I think the 20-day moving average sets up here. It's not on my strong earnings chart list, so I don't know that I'll trade it, but I really do like the setup here on Club. TCS. This is the Container Store. Problem here is that the volume's been waning, and as we move up, you can see the PPO continues to just kind of do nothing. But what we may see is just continuing consolidation until that PPO goes all the way back to the center line. I don't really see a trade setup here, so I'm going to avoid it, but I do like the overall chart. I love this volume coming in on the push to the upside back in May. Five Below. I really like this area at 97, 97.5. Today's low hit 97.62, got very close. I actually had an order in for this one at the 20-day. It did not hit, and it is reversing. But I think this one around 97, 97.5 would be a great reward to risk trade. ASNA, this is a smaller company, maybe a little bit riskier, but check out the volume in May and June as it made this huge run up. Now it's moving lower. What I'd really like to see, I've been looking for about this 335, 340 level in support, and you've got the 50-day moving average at 346. What I'd really like to see is a tail go down here below, maybe into the 320s, similar to what we saw in early June, and then reverse back up. That would probably be enough to get me into the stock. SRI, two more quickly here. SRI, I love this one as well. I think the 20-day moving average is not a bad entry. We're just below that right now. And gap support on this volume increase here, I think your gap support coming in at about 33.65 or so is going to hold on a closing basis. So that's what I would look for as potentially a second entry. Last one is Movado, MOV. And this one also gapped up, very heavy volume, $46 or maybe just below 46 is good support. We can see the selling beginning to pick up. It is down to 47.60. I think we might see that 46 in the coming day or two, maybe even a week. But look for some weakness there, and 46 is where I'd be looking for some support. Okay, so those were our stocks for today for the scooter report. Took a couple of different angles, and there you can see how Erin got to hers and the stocks that she discussed. And then I took a little different approach, just focusing on consumer discretionary and some of the top stocks in that area in the small and mid-cap arena.
Excellent.
Okay, yeah, another day, another day in the books. I tell you, I have been watching gold, though, and the GLD, first of all, on a daily basis, failed when it tried to rally back to the 20-day moving average. It's rolling over. And on a weekly basis, I think over the last couple of years, or maybe over the last year, we have not seen a weekly close below 118 on GLD. We're at 117.81 right now. So this could be a big week and a big breakdown.
There you go. There's a gold chart. Not GLD, but yeah, I've been watching that area of overhead resistance. It's just not going to give in at 1265. So hopefully it's going to hold at that 1240 level. But yeah, I don't know. The PMO was picking up, but it didn't manage to get it over that resistance level. So
yeah, I would steer clear of gold. I'm just not a fan of the commodities. I mean, energy, I certainly could find some arguments with the stocks, even though you do have a little bit of a headwind with the dollar. But I find it really difficult to look at some of these metals and be interested in them, especially given my thought process that the dollar goes higher, because I think the dollar will go higher in the second half of the year. And if it does, I just have many headwinds for gold.
Yeah, but your correlation is still reverse. So, you know, we should expect if dollar goes higher that gold's going to get hit. So, yeah, we'll have to see how it goes.
Yeah, it's going to be, interesting for gold to see if it can hold up this week. Right now, we do have the Dow still down 169 points. The NASDAQ and the Russell doing a little bit better on a relative basis, but they're down as well. It's really red across the board today. And I guess with those headlines this morning, we shouldn't be too shocked.
No, absolutely not. Well, there's our upcoming schedule for you. Tomorrow, Grayson Rose. I have sentiment on Friday. Probably going to continue my trading chart patterns workshop on Tuesday. And then Wednesday, Tom McClellan is coming back. I always love to talk to Tom, so that'll be fun.
Yeah, we definitely have a great list ahead, no doubt about it. We're certainly glad that everybody was able to join us today. Again, I want to thank Tushar Chande for joining us today. It's always great to have Tushar on the show. And yeah, wishing everybody a good rest of your day. Please remember to complete the survey as you exit. We'd love to get your feedback on Market Watchers Live, hear what you have to say. And as a quick reminder, Market Watchers Live does air 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody, and hopefully we'll see you back here tomorrow on Thursday. Happy trading.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.